Today, we're going to crack open a landmark piece of economic detective work. It's a 1992 paper called Money, Income, Prices, and Interest Rates. And really, it's a story about how a fundamental rule of economics just suddenly broke, and the frantic search for what could possibly replace it.
Right, so this is the paper itself, published by Benjamin Friedman and Kenneth Kuttner in the American Economic Review. And believe me, this thing fundamentally changed how central bankers think about the economy. So, let's dive in.
Okay, just imagine for a second, you're in the driver's seat of the entire U.S. economy. You've got all these levers and tools to manage the flow of money, trying to keep things growing steady without, overheating or crashing. What's the one gauge on your dashboard you trust more than any other?
Well, for a very long time, the answer to that question seemed almost obvious. Policymakers, central bankers, they all believed the key was to watch the total amount of money that was circulating in the economy. This was, without a doubt, the central rule in their playbook.
So let's actually take a peek inside this old rulebook. What exactly was this guiding principle that pretty much everyone, from academics to the folks at the Fed, relied on for so long?
The whole thing was built around this idea of the money supply. Now, economists have a few ways of measuring it, like M1, which is basically physical cash and money in checking accounts, and then the broader M2, which adds in things like savings accounts. And for decades, the thinking was simple. The amount of this money had a direct, predictable link to economic activity. It was like the trusted speedometer for the entire economy.
And look, this wasn't some fringe theory. As Friedman and Kuttner point out in their paper, there was a rock-solid consensus here. The belief was absolutely firm that if you watched how the money supply was moving, you had a really good idea of where income and prices were going to go next. It was that simple.
But what happens when that most trusted instrument on your dashboard, the one you've relied on for years, just suddenly starts giving you crazy, unreliable readings? Well, that is exactly what happened as the world headed into a new decade.
So, in the 1980s, economists and policymakers suddenly had this massive puzzle on their hands. That clean, predictable relationship between the money supply and the economy, it just started to fall apart. The very foundation for that widespread agreement, as the authors put it, just kind of disappeared.
And the breakdown was just stark. Before the 1980s, you could see this strong, clear correlation. You could look at money growth and pretty confidently predict what the economy was going to do. But after the 80s, that connection became fuzzy, weak, honestly statistically insignificant. The old rulebook was officially broken.
And this is where our story really turns into an investigation. Friedman and Kuttner basically put on their detective hats and started digging deep into the data to figure out what on earth was going on.
And the data they uncovered tells the whole story. You look at the period between 1960 and 1979, and yeah, both M1 and M2 showed a really strong link to the economy. But then you update the data to include the 1980s, and poof, that predictive power just vanishes. The link becomes weak, and in some cases, it's gone entirely.
The evidence was just undeniable. Trying to guide monetary policy by watching the money supply was now like trying to navigate a ship with a broken compass. Policymakers were essentially flying blind, and they urgently, desperately needed a new instrument.
And this is where the investigation takes a really fascinating turn. After proving the old tool was broken, Friedman and Kuttner uncovered a new one, a clue that was basically hiding in plain sight the whole time.
This was the billion-dollar question, right? The Federal Reserve, central banks all over the world were asking, if the quantity of money isn't a reliable guide anymore, what in the world can we use to predict where the economy is going?
And the answer they found was something called the paper bill spread. All it is the gap between two key interest rates, the rate that corporations pay for short-term loans, that's commercial paper, and the rate the U.S. government pays on its loans, Treasury bills. But this spread, it's not just a number. It's a powerful signal of how the market feels about risk. It's a barometer for economic confidence.
And this quote right here, from the paper's abstract, this is the smoking gun. While all those old money supply measures were failing, the authors found that this simple interest rate spread was remarkably consistent and, importantly, a significant predictor of future economic activity. And when you look at it visually, it's just stunning. You chart the paper bill spread over time, and this crystal clear pattern just jumps out at you. Right before each major recession, that spread would spike. It would widen out dramatically as lenders got nervous and started demanding higher interest from corporations. It was a warning signal that flashed bright red time and time again. Now, this discovery wasn't just some interesting academic finding. No, it had profound, real-world implications for how economic policy was going to be conducted from that point on.
So what are the big lessons we take away from this whole investigation? Well, first, that even the most established, rock-solid economic rules can and do fail. Second, policymakers have to constantly be testing their own assumptions against fresh data. And third, and this is a big one, sometimes the price of money, things like interest rates, can tell you way more than the quantity of money.
So the verdict from this whole economic mystery was clear. The era of just relying on one simple gauge, the money supply, was over. To steer the economy, you needed to look at a much more complex dashboard, with new indicators like the paper bill spread providing absolutely crucial information. And that really leaves us with one last crucial question to chew on. This paper showed how a core economic belief could just dissolve in about a decade. So it really makes you wonder, what widely accepted economic rule that we all rely on today might be the one that future economists look back on as the next great mystery?